Crypto bros love bragging about how easy it is to make money. But what often gets overlooked is how easily you can lose it too. One careless mistake can quickly turn a 100x gain into a 100% loss. That's why today we're breaking down the 10 most common mistakes that every crypto investor has made. And yes, that includes many of us here at the Coin Bureau. More importantly though, we'll show you how to avoid them so you can protect those life-changing gains. My name is Guy, and if you currently hold crypto or plan to in the future, this is a video you don't want to miss. Now, I'll start by saying that I'm not a financial advisor and nothing in this video should be taken as financial or investment advice. This video is purely for entertainment and educational purposes only. And with that out of the way, let's begin. So, the first mistake that every crypto investor makes is using the wrong exchange. That's because using the wrong exchange could result in you wasting time and money. And this is for two reasons. First, not every exchange will have the crypto that you're interested in. Some altcoins, especially those with smaller market caps, will have very limited exchange support. That said, you can easily check a crypto's exchange support on coin tracking sites like CoinMarketCap or CoinGecko. Second, exchanges will charge different fees for things like deposits, trades, and withdrawals. These fees are often ignored by investors, but they can quickly add up. Broadly speaking, larger exchanges with more coin support will charge the highest fees, while smaller exchanges with less coin support will usually be cheaper to use. As such, you'll want to find an exchange that works for you, one that supports the crypto that you're interested in and that also won't rip you off for buying that crypto. This can be easier said than done, but luckily there is a way to get the best of both worlds, and that's by using the exclusive discounts in the Coin Bureau deals page. Because that's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on crypto exchanges. So, what are you waiting for? Take advantage of them using the link down below. Now, the second mistake that every crypto investor makes is trading without a strategy. It's a tale as old as time. The crypto you've been holding for months has been lagging. You then see another crypto that's pumping and decide to sell your lagging crypto for the one that's going parabolic. You then wait for your portfolio to balloon in size, only to see it shrink instead. Then, to make matters worse, the crypto you originally held just went vertical and you've missed out. So you sell your now lagging crypto and try to catch the pump on the first, and the cycle continues. This is a fast track to getting wrecked, but it's hard to avoid. That's because wherever you turn, trading as much as possible is often actively encouraged. There are countless articles and videos and tweet threads about people making millions, and the trending sections of coin tracking sites often resemble casinos. Now, while it is entirely possible to make some mad gains by trading crypto, realistically, only a handful of traders possess the skills and the discipline to actually pull this off. What's more is that these traders make losing trades more often than you might think. The win rate of the best traders in the world is only around 60%, but consistency is what makes them profitable. Luckily, there are three things you can do to become a better crypto trader. The first is not to trade at all. For many of us, a simple buy and hold strategy will be the most profitable, and that's simply because it removes all the emotion, making us less likely to overtrade. The second thing you can do is to learn how to trade properly. Fair warning though, this is much easier said than done. You'll likely need to spend thousands of hours researching and practicing before you find a strategy that works for you. So, the third thing you can do is follow the Coin Bureau trading channel. That's where you'll find daily videos with unique trading insights from Aaron, aka Moomin Papa, and Dan, our very own head of research. So be sure to subscribe to the channel if you haven't already. The link is in the description below. Now, the third mistake is leaving all of your crypto on an exchange. This opens the door to unnecessary risk and arguably goes against the very ethos of cryptocurrency. That's because when your crypto sits on an exchange, that exchange has full custody of your assets. Put differently, what you hold is essentially an IOU. You technically do not own that crypto. Whether the market is soaring to new all-time highs or crashing after a black swan event, you might find yourself unable to access your funds when it matters the most. It's remarkable how often exchanges encounter technical difficulties during these critical moments. That's why there's a saying in crypto, not your keys, not your coins. And yet, despite this, many investors still keep their entire crypto holdings on exchanges for the sake of convenience, valuing instant trading ability over true ownership. Many investors shy away from setting up their own crypto wallet, assuming that it's too complicated, but in reality, folks, it's easier than it's ever been. Modern wallets are remarkably user-friendly, making the process virtually effortless. Plus, there's no better feeling than having full control over your own funds. That is the true definition of financial freedom, after all. That's why, ideally, you should choose a wallet that supports the cryptos you hold and transfer those cryptos into it. Keep in mind, though, that smaller cryptos may have limited wallet support. Pro tip, you can usually find compatible wallets listed in a project's documentation. Now, there are lots of wallet options available, ranging from hot to cold storage solutions. For those unfamiliar, hot wallets are internet-connected, usually mobile apps, making them more convenient, but also vulnerable to hacks. Conversely, cold wallets store your crypto offline. This makes your crypto less accessible, but also keeps it far away from online threats. Now, we've written several articles comparing the best crypto wallets over on the Coin Bureau website, which we'll link to in the description. Then, once you've found the right one for you, you'll find exclusive discounts for the best crypto hardware wallets on our deals page. So be sure to take advantage by, of course, using the link below. Okay, the fourth mistake that every crypto investor has made is investing into a coin or token without first doing your own research. Of all the mistakes on today's list, this has to be the most common and is also the one that usually results in the most losses. The severity of this mistake varies from doing incorrect research to not doing any research at all. Now, an example of doing incorrect research is watching a YouTube video about a crypto from a crypto influencer. Ironic, I know. That's because crypto influencers are often paid to shill crypto projects, and of course the result is that their research is biased. Indeed, they often do the bare minimum of research, focusing instead on hype and speculation. That's why you should never blindly judge a crypto based on what an influencer has said about it, even us. Ask yourself this: how many influencers have you seen just reading straight from a project's website? That is not really insightful. You could easily do that yourself. We like to do things differently here at the Coin Bureau, and we reckon these core values are exactly what has made us the biggest crypto YouTube channel in the world. We don't do paid shills, and we always disclose whenever we hold whatever crypto we're talking about. And on that note, if you want to see exactly what's in our personal portfolios, then become a Coin Bureau Club member. As a member, you'll get weekly reviews of promising altcoins voted on by you, our loyal CBC elite. You'll also get daily insights from our research team and gain access to our exclusive Discord channel. So you can sign up using the link below. Now, the fifth mistake that every crypto investor makes relates to the fourth, and that's aping into whatever crypto is pumping. This ape mentality is part of our nature. We see others making insane profits and we want a piece of the action. So we blindly ape in, hoping to catch our ticket to the moon. This almost never works. What's more is that this pumps the crypto's price, attracting more retail apes who believe that this crypto will keep pumping. In reality, though, this price action is often the result of whale manipulation and isn't sustainable in the long term. The worst part, though, is the way we try to rationalize this ape mentality by convincing ourselves that we're investing because of whatever narrative is behind the pump. We even believe that this narrative is why the crypto will continue to pump. Now, I'm not sure who needs to hear this, but the narrative usually comes after the pump. It rarely comes beforehand. So instead of looking at which crypto is pumping right now, you should instead ask yourself which crypto could pump next. To do this, simply look at the narrative of the crypto that's rallying and then look around to find a crypto in that narrative that hasn't taken off yet. Alternatively, you can explore other narratives related to the one that's currently pumping. A recent example of this was the meme coin surge at the start of this year. Many anticipated that DeFi would be next, given that meme coins are primarily traded on DEXs, a core part of DeFi. Sure enough, it wasn't long before capital flowed out of meme coins and into DeFi projects. Now, if you want to avoid getting caught up in all the FOMO, your best strategy is to stay informed about the crypto market and connect with like-minded investors who are looking to play this game the right way. Unfortunately, you can do all of this by joining our social media channels, the links to which are in the description below. So, the sixth mistake many crypto investors make is allocating too much capital into crypto. You sometimes hear stories of investors selling their house or car or even borrowing heavily just to go all in. While the commitment is admirable, it's almost never a wise move, especially if it sacrifices your quality of life. It's easy to forget that crypto is a highly volatile and risky asset class, which is why you should never invest more than you're prepared to lose. If you're checking your portfolio every 5 minutes and panicking over a 5% drop, it's a clear sign that you may have overextended, and it might be time to scale back your positions. There's also the mistake of not diversifying your crypto investments in the correct way. On the one extreme, you could go all in on one particular crypto, which significantly increases the amount of risk. If that crypto crashes, or worse, goes to zero, then your entire portfolio will take a beating. Meanwhile, at the other extreme is allocating towards too many cryptos. While this is perhaps safer, it also significantly reduces the gains that you could make. Not only will you struggle to keep up with every single project, but the rewards will be much smaller since there was less capital invested into each one. Ultimately, how you diversify your portfolio depends on your own risk tolerance, but a strategy used by many investors is to allocate across different crypto niches, especially into those that haven't pumped yet but could do so in the near future, since that's where the biggest gains will often be found. Okay, now the seventh mistake every crypto investor makes is setting unrealistic expectations. We've all heard of that one degen who bought some shitcoin and became a millionaire overnight. While this can happen, the reality is that it almost definitely won't. More often than not, you're going to be playing the long game. The real danger, though, of setting unrealistic expectations is convincing yourself that you're too experienced to make common mistakes, as if you're somehow exempt from them. The truth is, even the most seasoned and well-informed crypto investors slip up. So, none of us should be banking on life-changing gains in a single day, week, or even month. On top of that, many investors assume that if an influencer promises 100x gains, those returns are practically guaranteed. The reality, though, is that discovering a crypto gem with that kind of moonshot potential is far more challenging than it used to be. With so many coins and tokens on the market today, the competition for capital is stronger than ever. So, rather than waiting for your portfolio to gain some extra zeros, focus instead on creating clear goals and then stick to the plan. For example, you could decide to sell half of your crypto in the future once that half can buy you, say, a new house. This approach will bring discipline to your investment strategy and make those dreams a reality much, much sooner. Next up, the eighth mistake relates to the seventh, and that's refusing to believe that your crypto may not be as successful as you first thought, or even that the crypto market as a whole could struggle. This mentality is known as marrying your bags and can quickly become an abusive relationship. Marrying your bag often begins when you first fall in love with a project, whether it's for its groundbreaking tech, stellar development team, compelling narrative, or something else entirely. If the project really is legit, but the price is lagging, then you're probably best to keep hodling. But if you catch yourself ignoring red flags, then it may be time to consider a divorce. Now, the worst part of marrying your bags is watching the price plummet for whatever reason and seeing this as an opportunity to buy the dip. This is known as trying to catch a falling knife, and this is where the marriage gets truly bloody. Trying to buy the dip when the price is crashing will only increase your exposure to loss. So just don't do it. Before you find yourself holding the bag, approach these riskier trades with a clear take-profit strategy. More importantly, if the price is crashing, wait for it to bottom out before making any moves. If you still believe in the project's long-term potential, then you can consider this a way to increase your allocation at a discount. Now, this relates to the 9th mistake that every crypto investor makes, and that's not taking profits, aka round-tripping your bags. This refers to when you buy a crypto at a low price, ride it all the way up, not take any profit, and then ride it all the way back down again. Round-tripping your bags is one of the most painful mistakes an investor can make, and the worst part is you probably won't realize you're doing it until it's too late. It's a tough trap to avoid though, because as crypto investors, we naturally want our tokens to go vertical. But the truth is, nothing goes up forever. Newsflash, when you start feeling like nothing can stop your crypto's mission to the moon, that's probably exactly when you should consider selling, or at least taking some profits. Sure, it could continue to rally, but are you willing to risk losing those gains if the price goes to zero? Wouldn't you feel better knowing you've locked in some profits, even if the price keeps climbing? Obviously, the answers to these questions will depend on your own individual risk tolerances and circumstances. That is, how much you initially invested, how much that crypto is worth now, and how much that money means to you. Ultimately, this is down to you to determine for yourself. For what it's worth, though, you'll know you've made the right call when you find yourself breathing a sigh of relief rather than being overwhelmed by FUD or FOMO. Managing your emotions is one of the most important skills to master if you want to be successful in crypto after all. All right, folks, this brings us to the 10th mistake that many crypto investors make, forgetting about crypto's long-term price potential. It's easy to believe that the only way to profit is by constantly trading the most speculative coins and tokens. But even if you miss the chance to take profits, holding for the long term can still give you some mad gains. If your crypto research uncovers an undervalued coin or token with strong fundamentals and a clear long-term vision, then missing out on short-term profit-taking becomes far less significant. In fact, even if you make several of the mistakes mentioned in this video, a long-term perspective can help you cut through the noise and stay focused on growing your portfolio over time. What's more is that even if you completely miss the boat and find yourself holding your crypto into a bear market, then chances are that you'll be in profit again in just a few years' time, or whenever the next bull market comes around. Now, this is important because it can be tempting to cut your losses during a bear market, but really you should be focusing on accumulating more crypto. That's the prime opportunity to position yourself ahead of the bull market and the insane rallies that will likely follow. But you don't have to wait for a bear market to start stacking the most promising cryptos. And if you need some help on how to do your own research into a specific cryptocurrency, then good news, we have a video right over here that will teach you how to do just that. Okay, and that is all from me for today. So thank you all for watching. Like and subscribe if you got something from this video, and I will see you again very soon. This is Guy, signing off.